On October 9, 2011, a roaring inferno tore through the heart of a 123 Systems Michigan factory, sending plumes of black smoke skyward, and marking the day the electric car dream began its most violent tumble. In the span of less than a decade, this once celebrated startup rose from a DARPA-funded lab experiment to a multi-billion-dollar darling of Washington's clean energy agenda, only to implode under the weight of its own ambition, missteps, and a tangled web of government subsidies. The story begins in 2001, when a small team of MIT engineers, led by Dr. Yetming Chiang, unlocked the secret of lithium iron phosphate (LiFePO4) chemistry. Their breakthrough promised a safer, longer-lasting battery, one that would not overheat or explode like its cobalt-based rivals. The United States Department of Energy, eager to accelerate the nation's transition to electric vehicles, saw the technology as a strategic asset. In 2005, the DOE awarded A123 its first major grant, and the company was thrust onto the national stage. Within a few short years, A123 secured contracts with automotive giants General Motors, Honda, and Toyota, promising to power the next generation of plug-in hybrids. The buzz was electric, and Wall Street took notice. By 2009, the company had raised over $500 million from a mix of venture capital, private equity, and a $249 million loan from the DOE's Advanced Technology Vehicles Manufacturing Loan Program. The headline was clear. A123 was the battery of the future, and America was finally catching up to Asia's dominance in the sector. Yet, beneath the glossy press releases, warning signs began to flicker. The first clue emerged in the form of aggressive cost targets. To meet the DOE's loan requirements, A123 was forced to slash production expenses while scaling up at a breakneck pace. Engineers reported that the newly built Michigan plant, a $250 million facility meant to churn out 10,000 battery packs per month, was plagued by quality control issues. "We were building speed, not reliability," recalled a former production manager, his voice still tinged with the hum of failing equipment. Compounding the problem, the market was shifting faster than the company could adapt. Tesla's sleek Model S, launched in 2012, demonstrated that lithium-ion batteries could deliver both performance and range without the safety concerns that had once haunted A123's chemistry. Simultaneously, Chinese manufacturers flooded the market with low-cost cells, eroding the price advantage that a 123 had hoped to leverage. The company's balance sheet began to show the strain. Inventory piled up, cash burn accelerated, and the loan from the DOE, meant as a catalyst, turned into a looming deadline. The fire of October 9, 2011 was more than an isolated incident. It was the physical manifestation of those deeper problems. An explosion in the cell assembly line, traced to a faulty coolant system, forced the plant to shut down for weeks. Production targets slipped, and the company missed a crucial milestone in its loan agreement: the delivery of 5,000 battery packs to a joint venture with Honda by the end of 2011. The DOE, which had initially praised A123 as a model of clean energy innovation, now sent a stern warning: failure to meet loan terms may result in a default. By early 2012, the pressure was palpable. Investors grew restless, and the board pushed for a rapid infusion of cash. In March, A123 announced a strategic partnership with a Chinese battery maker, hoping to offload some manufacturing risk and gain access to cheaper raw materials. The move, however, sparked concerns about intellectual property leakage and further diluted the company's focus. Meanwhile, internal emails, later leaked in a lawsuit, revealed a leadership team divided between push for volume at any cost and reinforce quality and safety. The discord translated into missed deadlines, product recalls, and a growing mistrust among OEM partners. On August 30, 2012, the inevitable happened. The DOE issued a formal notice of default on A123's $249 million loan, demanding immediate repayment. With cash reserves dwindling and no clear path to profitability, the company filed for Chapter 11 bankruptcy just weeks later, on October 16, 2012. The filing listed $1.2 billion in assets against $1.5 billion in liabilities, a staggering deficit that sent shockwaves through the clean energy community. Employees were laid off en masse, the Michigan plant shuttered, and the once promising battery packs vanished from the shelves of auto manufacturers. The collapse sent ripples far beyond A123's own doors. The DOE's loan program, already under scrutiny for its involvement with Solyndra, now faced accusations of favoritism and poor oversight. Congressional hearings probed whether the agency had been too eager to fund unproven technology, and the A123 debacle became a cautionary tale about the perils of coupling massive public money with untested private ventures. For the automotive industry, the fallout forced a recalibration. Manufacturers accelerated in-house battery development or turned to more reliable suppliers, delaying some electric vehicle rollouts but ultimately spurring a more diversified supply chain. In the years that followed, the remnants of A123 were sold off in pieces. The intellectual property was acquired by a consortium of Chinese firms, who continue to develop Li-Fi PO4 cells for grid storage applications, a modest echo of the original vision. The former CEO, John Krafcik, moved on to become the CEO of Waymo, while former engineers found new homes at Tesla, Bide, and other emerging battery startups. The Michigan facility, once a symbol of American manufacturing resurgence, was repurposed for aerospace component production, a quiet reminder that industrial dreams can be reborn in unexpected forms. Subscribe to The Collapse for more stories like this.